Welcome, everyone. It's Angelo Robles, and welcome to Family Office TV. I'm also the founder and chairman of SFO Continuity, a private membership club. We're going to come back to that towards the end. For the new audience, or those that haven't seen me in a while, in the family office world, which is my life, I'm most known as being the founder and longtime CEO at Family Office Association. I had a successful exit a little over a year ago, and out of my beloved Wyoming, had a chance to create a holding company, a family office, and soon to be a private trust company. But I enjoy what I do, meeting incredible people, including our very special guest today, which I'm doing a series of short, at least by my standards, not one of my 3-hour interviews, but my short form interviews today. It's been great. And we're going to cover, how could you not like this subject? A founder of Harvard Management Company to investing in over 900 private companies. Our special guest today is George Siguler. He's a founding partner and executive chairman of Iconic alternative asset management firm, one of the largest in the world, Siguler Guff. George has his own family office, and in 1974, he was one of the founders that created the Harvard Management Company that really ushered in a new wave of endowment model of investing. And that was one of the interviews that I did with George. So you can watch and learn all about that in that 40-minute interview that we did a little earlier today. But on that note, George, it's great to have you here. It's a pleasure. And I think what I said that's going to get attention is you've invested in over 900 private companies. If you had to narrow down one or two lessons that you've learned of what works and what doesn't work, what could you help share with our family offices?
Well, we ended up doing it as many times as we did based on a model and a philosophy that really goes back to the 1970s with me. Almost every one of these 900 companies was a small to medium-sized family business. So what we like to find is a company that's been around for 30 years, that has a defensible product or a niche or a moat around it that allows it to sustain itself. And the family is now in a position that it makes sense for them to sell or do something to create a succession management and the like. We want to be the first institutional capital in the structure. We could buy 100% of the company, but oftentimes and preferably we would leave the family in for a quarter, a third of the company, because we want the continuity of what's good, but we also want to basically help the companies grow to their full potential, and so clean them up a little bit. I kiddingly say get rid of the brother-in-laws and the stale inventory, and improve marketing. Maybe they've got a product that with our contacts and relationships could get into Costco and change the dynamics of the demand and such. So that's the model. We then built an infrastructure, and I first did this at Harvard, and learned it from the retired head of Textron, found him really little, who did this in the 60s and 70s and created a company called Narragansett Capital.
Yeah, of course.
Which was publicly traded, and in 1986, I bought the company and liquidated it and sold off all 47 companies that we had, which is with a great return. So we built our teams around this. We do this in a model where we invest with small managers around the country who have either geographic expertise or industry-specific expertise. About half the money goes into these organizations, and the other half we're investing directly or side by side with them. So the founder of Greylock, Bill Elfers, taught me something that's a great lesson that everybody should think about is deal flow is everything. If you see,
that was my next question.
You see 10 deals and you're smart and you can pick out the best 2 or 3. If you only see 5, you got to still find a way to put money to work into 3. If you only have 1 or 2 deals, you're just going to make big mistakes. And so a lot of this is deep due diligence. A lot of this is just pattern recognition. The family's going to have one transaction probably in a lifetime, and we're doing one or two a month, and so it's that expertise there. We want to be the first institutional money in. We can demonstrate in almost every case that the business that was there before gets a huge goose of opportunity around the time of the transaction. Growth rates expand, margins expand, incentives are working there, and you also have a company that on an exit will be attractive to a strategic buyer. So we've got lots of companies, whether it's a specialty food product company that's in this narrow niche, all of a sudden it would fit into craft and the like. So our exits are sometimes to larger buyout firms on a much larger scale, or to strategics. But we want to catch them at that first level.
And just here in America alone, there actually are millions of businesses for sale. A lot of them owned by baby boomers. They're aging. And a lot of them are what I would call, and my audience knows I use these words, blue-collar, somewhat recession-resistant businesses. But because the businesses are going well, a lot of the children are well-educated, they don't necessarily want to work in what mom or dad or the family or in that specific industry. That creates opportunity. Yet over 90% of businesses for sale don't sell after 1 year. And the competition among people like yourself that are professionals, among family offices, it's fierce. How would you recommend maybe an ultra high net worth investor or a small to mid-sized family office? How do they source the deals in a given vertical, and how do they compete against the professionals?
Well, I mean, it's unlikely they can compete against the professionals. They need to hire the professionals in some sense. I mean, not meant to be self-serving, but somebody's out there in the market flushing it out. Again, deal flow is everything. So you want to find the characteristics that are going to work for you. And then in the family office context, hold on to them long enough so that you're going to create gains, but you basically want to defer the taxes on them as long as you can. The business is oftentimes local, and so there are families in Cleveland that invest with managers in Cleveland who are in this space. Sometimes they'll co-invest side by side and have the potential to avoid capital, minimizing or lowering the amount of management fees they have. There's sometimes when people are a minority investor and the company's being resold after the gain, that they'll stay into the transaction for the next round, sort of in a continuation type vehicle. Sure. So, the industry of private equity and buying kind of companies wasn't built around family capital. It was really built around institutional capital from pension plans, endowments, and foundations. So we're in an interesting position in history right now where there will be a change, and there will be longer duration capital vehicles created for people, or things that where they can stay in for an indeterminate amount of time. The model up until now has basically been come in, improve the company, grow the EBITDA, and
get the hell out.
Sell it.
And families have potentially time on their side. Sure. They could be very patient capital.
Absolutely.
They're not necessarily answering the LPs that may want to see a return or an exit sooner rather than later.
So it's, as I say, it's a really interesting time in history because the perception for the demand for this type of asset investing is coming forth. Up until now, I mean, families were, buy the S&P 500 and own some bonds and maybe have the core of your wealth, the business your family still owns.
Right.
And once you get to the point where that's been sold, then you need to find other ways to deploy capital in a tax efficient way. And owning a piece of a company like ones we invest in makes an awful lot of sense.
And when you source an opportunity and let's go with the word negotiating, what's more important, the price you pay or the terms you receive?
Well, I mean, we're basically buying to get control of the company. So, unambiguous, we would not take a minority position. Us and the co-manager, like, so the family has given up control, but they've been sold on what the transaction can bring. I mean, oftentimes the best sale we can do to get a transaction done is refer the family to 5 or 6 other companies we've done in the past. And then they learn that, we did what we said we would do, the business did improve, and on the second exit 4 years later, they actually made almost as much money as they made the first time, because the business has improved in terms of EBITDA and the like. We're talking here businesses, I mean, we call them small, for some people wouldn't say that. It's a company making $5 to $15 million of earnings before interest and taxes, and that you can buy for 6.5 times such. The market's gotten somewhat more expensive. Used to buy things at 5 times.
There's more private equity firms, I could argue, that are overpaying in the market, but they got to deploy the capital.
Yeah. But, it's private equity has a lot of merit and benefits to them. If you're a manager of a public company, you can have your business plan and you can execute it perfectly, and your stock could go down. You can't. That variable is not controllable. If you look at a private equity transaction, saying we're going in there, they're earning $5 million in EBIT now.
Right.
We believe we can get that to $10 million in 5 years.
Right.
And we know the market will clear a company growing like that with a clean balance sheet at 10 times earnings. We will have tripled our money. So it's a pretty straightforward exercise. Put your money to work.
Oh, I agree. Compared to venture capital, which I know is exciting, right now is not a great time in the market for it, but that's where you get the incredible exponential returns. But you're competing against the professionals who usually fail at the individual companies that they pick. When I'm buying the kind of business that I'm talking about, I'm already buying a profitable company. Right. I'm not looking to turn it around. I would need to bring on, I would think, a turnaround specialist. What could I do to enhance their processes, their system, their operations? And I could argue in today's world, marketing, social media, depending on the business. I'm going a little quicker in round robin because we have a little bit of a limited amount of time. We'll probably in a couple of weeks do a part 2 on this, but in continuing, what type of diligence do you do, or thinking about it more from a family perspective on private investments before you pull the trigger? Meaning, if I'm going to send a letter of intent that's non-binding, maybe all I really want to know is the ownership structure, the cap table, profit and loss, P&L this year and for 3 years prior, and then I could spend more time in legal and internal costs to do deeper diligence. Do I need to do that early on?
Generally speaking, you want to be the sole potential buyer, and this is an iterative process. It oftentimes takes months, if not a year or more. But when it comes to doing the due diligence, I mean, we have our own teams with our own expertise, but we go into enormous depth with specific industry expertise, both bringing in experts in every aspect of the business we're doing, whether it's GLG we use or somebody else. But
sure,
but quality of earnings and then obviously there's getting to genuine real finances. I mean financials. I mean, it's as much diligence as you would do in a bigger company.
Could I argue a little bit that a family's advantage, and this may bite them in the butt too, is in theory they can move very quick, and that could be good?
It's generally not that way. It's hard to let go, and because we want them to stay in for a piece, it's also hard to hide any sins.
That is true. And I'm going to bring up Warren Buffett because families are going to look at that as create a holding company, buy companies, be a long-term investor. And all of that is great. We should all analyze what the incredible Warren Buffett and Charlie Munger have done. It's incredible. They're amazing investors, and, rest in peace, Charlie Munger, an iconic man, philosopher, in my opinion, and investor. But there were certain advantages that Berkshire Hathaway had that perhaps the average family is not going to have?
No, I say Charlie and I served on the board of Hoover Institution together, so I got to know Charlie in the last years of his life, and it's a fascinating person and such. But no, I think that there's a certain element of scale you have to have. I mean, our transactions are going to be $50-100 million type transactions when you get this thing to scale. So a certain size family office and could do it and are doing it. I mean, they've hired real teams and the like. It takes a certain amount of capital or a clump of capital to pull this off. And I think it's going to happen. It makes so much sense that it will happen, but we're not quite there in scale yet. But again, people ought to be looking at it that way. I mean, to own a business where you can control how much is going into R&D, how much is going into marketing, what is it going to take to make this a better business, all inside a structure that allows the inside buildup of wealth to avoid taxation. Early taxation, I guess.
Well, it helped to have the insurance company structure.
I mean, in Buffett's case, he backed into having insurance holding company structure that was not challenged because had he just been a company that owned stock in many different companies, he would have been required under the Investment Company Act to pay dividends and to behave like a mutual fund. But the fact that these assets were owned inside the insurance company and then eventually Geico and Gen Re, it also gave him a chance that in certain types of reinsurance he would do. He would just own all this Coca-Cola stock. You can pledge that against surplus relief and charge an extra 300 basis points on something you're going to own anyway. And that's part of what generates so much cash for him.
Warren's a smart man. George, you have some philosophies about even in challenging markets that a sharp investor, and maybe they need to look at certain esoteric opportunities, there still are ways for them to get double-digit returns. We don't have the time to probably do a deep dive into all 10, but maybe if you could pick out a couple.
Well, I mean, a lot of it is where we are in the market and time. To one degree, I know there's always a certain amount of distressed debt out there. And we've done several $1 billion of this in the past as a firm when the opportunities were overwhelming. Global financial crisis, the telecom collapse with the WorldComs and the like. Not a huge amount of that, but they are. The change in interest rates have created lots of dislocations for people to need pleasantly, you say, structured capital, some call it relief capital.
And you think the banks aren't there to help as much?
And the banks are so tied up with regulation right now.
Yeah.
And so, you look at in the real estate sector, perfectly good property, perfectly good weighted average lease turned there, but the senior debt was at 3.5, and now it's going to get refinanced at 6 or 6.5. The equity is sitting there below it. There's a gap in the middle of 20% and something more of the valuation of the business. The equity doesn't have the capital, and the senior lender's not going to advance the capital. The person stepping into the middle can write their own ticket. And so there's an amount of sort of relief transactions out there. They'll pay you 12, 14, 16% on the expectation that the company will find a way to refinance it out. There's also somewhat of a bet that yield curve will steepen naturally, and that short rates will be somewhat less than 5% at some point in the next 2 and 3 years. So, again, it's a loan there. You have to really be careful on the underwriting and the cash flow.
Of course.
But these leases have escalators and the like, and very, very good money on it. They're capital relief transactions for banks. For them, again, the amount of allocated capital to the loan makes the loan unprofitable. They use third-party capital to provide the capital underneath the loan,
right,
and such. We're seeing things in government program lending, producing stuff with USDA on bridge financing on people who are getting loan guarantees for projects, out of the U.S. Department of Agriculture.
Mm-hmm.
So, and there's no shortage of things right now. As I said, we're talking to our fixed income team. We kiddingly say there are at least 10 or 12 ways to make 12% in today's market.
And I believe
funding legal transactions. So
that was my next comment. Be maybe different than the audience thinks I'm going to go, but that one too. George, your organization that you built, Siguler and Guff, is doing something pretty intriguing from that perspective in Brazil. If maybe you could describe it in a minute or two to our audience.
As under the Brazilian Constitution, the country doesn't claim sovereign immunity to prohibit its citizens from suing the government for wrong acts. And that's created a judicial system that's illegal and effective and such. And so their claims against government could be that they force price charge you an illegal or an export tax that was inappropriate, that they had waging price controls that prohibited you from making a profit making ethanol. Any number of these things go into the judicial process as a legal claim. Takes a number of years to look through the primary, the secondary, and the Supreme Court. And then a period of time to determine the full magnitude of the loss, given the historic high inflation rates and the like. So the end product is something called a precontorno, and it's a legal obligation of the government to put this into the budget and to pay the holder of the precontorno some money. It's now going in, the government's paying north of $10 billion a year in claims like this. The government, on the other hand, is also suing people from the opposite side. They didn't pay their tax and like, so it's symmetrical. The government's actually probably have higher claims that they feel they're due than they owe. But we've got a real expertise in the space. We've got a team on the ground in Sao Paulo, and we're doing these things for pricing returns in the 20% range in Brazilian currency.
Wow.
And Brazilian currency has had its history of instability, but over the last couple of years has actually been pretty good.
Do you think that family offices, and probably it's very specific, should they be looking at energy, oil and gas, wildcatting?
Yeah, oil and gas is, there's an excess return to be had from participating in oil and gas. Oil and gas will be with us for the next 100 years. And there's no conceivable way we can go to net zero carbon. It just absolutely cannot be done. And so those who are willing to say, I'm going to invest there because so much capital has been drawn from the market from ideological or political reasons, there's an excess return there. And so, you can do senior drilling in places like the Permian Basin and generate first dollars to the capital returns of 16-17%.
Right, correct.
And it's just a very interesting, inefficient market because of the geopolitical issues to it.
Exactly. Any specific opinions about SPACs?
We sort of said it was a disaster going to happen, and it was a disaster that happened. And it was, the market could absorb a dozen SPACs a year, probably, but the notion that there were going to be 200, 300, 400 ideal companies to step up to and buy was just inconceivable. There was no supply that was going to match the demand created. And it was then treated sort of as a gimmick that you can have, short-term rates were zero, so you could have a vehicle that's going to give you an interest rate if you just pulled your money back from the SPAC. So people were committing to them with no intention of putting equity in.
Right.
Generated a lot of investment bankers' fees and a lot of heartache. There was a time REITs were the same way, and then they found their legitimate use and dominate the industry. I think that there's probably room for a handful of SPACs done by people who need access to great deal flow.
And I would love to go over geopolitical, economic, macro, inflation, interest rates. We're going to save that for some of the in-person gatherings we're going to do within my SFO continuity with George and others, and maybe some of them with a interview in the later this summer, early fall, on a little bit of kind of a part two of this. In wrapping up a little bit before I close, a lot of the families still are in short-term treasuries, and I get it. It's paying 5%. It's short-term. Do you see them beginning to move off that? Is it going to be a reflection? And we don't really have the time to get into inflation and interest rates. But,
I mean, 5% short term is better than zero short term.
yes.
But remember, the government gets half. And so.
And inflation, we all know it's not really 4%.
The difference between 2% inflation and 3% inflation is not 1%, it's 50%.
Exactly.
And it's very hard to wring out of the system. I mean, very, very few people will remember what life was like in the late 70s and early 80s. And
I do.
So it was a painful time. And so, the Fed kind of had it wrong. And when they said there were going to be 7 cuts this year, my bet was 0. And so far, I'm still right.
Yeah, indeed. I wish we had more time. I do recommend watching my interview with George on the Harvard Management Company, the Harvard Endowment, because things like Merge Arb, earlier stage stories about Kravitz and KKR, lots of good things there, including a little bit on VC and early involvement, very early with some of the titans of that back in the 70s, and there'll be more to follow. So a little bit of an announcement that I wanted to make. And again, for those of you that are new, I'm most known as being the founder, longtime CEO at Family Office Association. I am myself an active allocator, and I'm very interested in investing in private companies. That made it extra intriguing to have a conversation with George. I'm also looking at some oil and gas and wildcatting. So it's been a very interesting time, but I love to do the interviews. Family Office TV is near and dear to my heart, but I did decide a couple of months back to really go forward in a private membership club called SFO Continuity, where initially getting together with 30 founding members and then growing that over time, mainly in New York and Palm Beach. But I love Jackson Hole, a little bit the Hamptons, LA, and I go to Europe once or twice a year. So New York and Palm Beach will be our hubs, but I do look to diversify that as well. And the opportunity without sponsorship really focused on incredible investors and family offices getting together, sharing ideas, best practices, deal flow opportunities to club deal, to co-invest. George and his amazing organization, having invested in almost 1,000 different companies and have companies that do maybe segue out of Siguler and Guff in the private equity and could be available for families, whether individually, if they're large enough, or clubbing deals together. There is lots of opportunity here. So I'm very fortunate to announce it's an honor to have George as one of the 30 founding members, and especially here in New York until we segue to Palm Beach into the late fall and winter, an opportunity for very intimate gatherings with George and people like him to get together, have very meaningful conversations, to learn from one another, and have the opportunity of, again, sharing ideas on oil and gas, on ranch land, on real estate, on Web3, on AI, on opportunities in venture and private companies and my beloved blue-collar, recession-resistant businesses. So on that note, everyone, I'm Angelo Robles. Go to angelorobles.com and learn more. There still are a couple of opportunities for the right people as an ultra high net worth investor or family office to come on as a founding member to SFO Continuity. But even if not, or not a good fit, I still want to learn what you do. I still provide great free information at Family Office TV. Follow me across all social media. George, it really has been an honor on this rainy day here in late spring in New York. It's a pleasure to have you on. I look forward to our follow-up.
Thank you.
Thank you so much. George Siguler, everyone. Thank you.